Hi, this is Skyler Weinand with Regan Capital. Today, we want to briefly talk about mortgage rates and the potential for rates to drop, given that the Fed has signaled that they're going to lower interest rates shortly. So, taking a look, most of these charts we'll go over are the 5-year chart, is I think it's fairly relevant to look at pre-COVID to today. And so, looking at today's mortgage rate at about 6.5%, down from a high of almost 8. Okay. Going into COVID, mortgage rates were about 4. 2018, they were about 5. And as we all know, they dropped to a low of about 2.5% come post COVID 2020, 2021. So we want to look at the inputs into mortgage rates and starting with the 5-year treasury. Mortgages generally are a mix of off of the 5 and 10-year. So if we look at the 5-year, which got to a low of 22 basis points, today stands at about 364. When the Fed started raising interest rates about right here, it was as low as 138. Got to as high as about 5. Potentially this drops another 10 to 15 basis points. If we look at the forward SOFR curve, uh, which implies a ton of rate cuts over the next 2+ years. Over the next year, the Fed is supposed to, according to the curve, drop interest rates 2.1%, about 8.5 Fed cuts. And over the next 2 years, drop upwards of 10 times from 550 down to about 3%. That's a huge rate drop. If that were to occur, we would expect the 5-year to potentially drop, call it somewhere between 20 and 50 basis points. Okay. Call it from 3 to 3.25% or so. So one other input is spreads, mortgage spreads. Okay. So this is called the current coupon mortgage spread, which is the rate at which mortgage-backed securities trade, i.e. Fannie, Freddie, Ginnie, relative to 5 and 10-year treasuries, a 5 and 10-year blend. So right now we're at about 137 basis points over treasuries, which is actually low relative to the last year and a half or so when the Fed started raising interest rates here. But relative to history is a little bit bloated. I'd say on average, we're looking at more like 100 to 110 basis points. And so you could see this dropping 15 to 25 basis points. And why would that happen? Well, there's two inputs, and we'll get to it in a second. But I first of all want to cover where 30-year mortgages are relative to that 5-year, because these are a little bit different. Okay, this is your current coupon spread, whereas this is the prevailing mortgage rate, which implies there are some other inputs in addition to spread, whether that's the cost of servicing, the cost of the government to insure, origination costs, the primary secondary spread. So you can see here it's about 275 basis points over, which again, relative to the last 5 years, it's a little bit bloated. It's a little bit high. I'd say, maybe it has 15 to 25 basis points to drop. Okay. And what are the inputs to that? There's two major inputs from what we see. Volatility. Here we have the move index at 105. Anything over 100 is relatively high. We would expect this to eventually drop to call it 80, okay, which is what we saw pre-Fed interest rate rises. Now that the Fed has set more of a concrete path in terms of what they're going to do, we could see vol come down, call it 25 basis points from here. And mirroring that is the dollar index. Okay. This is the dollar relative to a basket of currencies at 101. We would expect that to come down a little bit. These two things are somewhat intertwined. In addition to that, it's demand. Okay. Who's buying mortgage bonds? And we see here we have commercial bank. Now this is treasuries and mortgage bonds. And they have dropped their holdings from about 3 trillion at their peak, this is a year before Silicon Valley Bank blew up. They started dropping their purchases. I don't know if they were actively selling, but they definitely weren't buying. So you went from 3 trillion to a trough of about 2.45. Today we're at about 2.6. And then you have the other large owner out there, the federal government, okay, which peaked at about 2.7 trillion. Today's at about 2.3 trillion. Add those two up, you have a $400 billion drop and roughly another $400 billion drop. The two largest players out there haven't been buying, okay? We are seeing banks starting to come back to the table. We don't see the federal government coming back in with QE anytime soon. But with banks dipping their toe in the water again for mortgages and the government at least not selling, we are going to see a little bit more demand. So going back to where we think mortgage rates could go, okay, if we look at a drop in spreads coming from vol and maybe increased demand, we could see another 25, 35 basis points in drop. Add on to that, if this plays out, if the Fed cuts two percentage points in the next year and a half or so, yeah, we would expect the 5-year Treasury to come down, call it 25 to 50 basis points as well. So you add those two up, it gets us to a mortgage rate, a prevailing mortgage rate for agencies of call it somewhere between 5.75 and 6, which will in turn, in our opinion, lead to higher refinance as well as purchase activity, i.e. higher prepayment rates, which for the bulk of mortgages outstanding, which are all trading at significant discounts to par, would be a very good thing. We're looking at almost all-time lows in terms of prepayment activity at 5-6% annualized. We could see that easily getting back to 10 to 12, i.e. doubling from here, which will add a lot of value to discounted mortgage bonds. Thank you.